Good evening, everyone. So after this power-packed session that we were just having with lot of KBC questions, right, I think again time for some KBC. And as the host has already set the context with respect to passive investing, and we all normally shy away with passive investing, right? So to start with, I'd like to ask a question to all of you. How many of you actually suggest index investing to your investors? So in a room of say close to 100 people, I'm seeing 2 hands raised. Any particular reason of not doing so? That why they are doing? Right. So ultimately what you are bothered? You are bothered about the portfolio or the returns? That's fine, but what you are bothered about? Parag keeping cash position or Parag giving returns? So, I mean, the problem is passive is not allowing you to keep cash or passive not generating returns. Because, let's be honest, everybody of us are bothered only about one thing, which is scheme return. Am I correct? Right? So, why passives are not so popular in this room? I mean, I'm sure this is a room full of vibrant people in the MF space, right, in Chennai market, and I'm seeing only 2 hands, which is actually a matter of worry. Yes, the first reason is the belief that passives cannot generate alpha. Right? That is the reason. See, ultimately, as an advisor, what is your role? To enhance the investor's return, and that you can do only by creating alpha for investors. And the belief that passive cannot generate alpha is the major reason you are not touching index funds. Is there any other reason? Yes. The second reason is that these are not commercially viable for me. Right? While in an active scheme, my brokerages is on the higher side, the passive, in case of passive, the brokerages are not that attractive. So ultimately, as a distributor, I also have to see my balance sheet, right? So it should also be commercially viable for me to pick that category. Apart from that, is there any other reason? Sorry? So that actually captures in performance. So the why alpha is not there is because of all those restrictions that passive has. So in active also, if you see, there are a lot of active schemes where a lot of stocks are underperforming, and are they removing it? They may move, but are they moving? So that is about discretionary, non-discretionary portfolio, but I think that broadly covers under underperformance. Yes, it is actually riskless. I think the third reason why most of us don't touch index investing is particularly lack of awareness also. Right. So in this next 30 minutes, what we'll try to do is, we'll try to answer all the 3 questions that you have. And if I can convincingly answer that, I hope that hands will not be 2 anymore. Right? So let's start with the first point, which is passive does not have potential to generate alpha. So, I mean, just to give you some background there is that if we actually see the 2 investment approaches that is available in the mutual fund side is active and passive, right? What is the biggest advantage of active is just what has been addressed by the crowd is that the actives have potential to outperform the market. Yeah, we will do. Active schemes have potential to generate alpha, and that is why they are so popular. What is the challenge of an active scheme is that it is all discretionary in nature, which means a fund manager basis his understanding of the market, creates a story around that market, builds a portfolio around that story. If that story works, there is alpha. If that story does not work, there is no alpha. And that is the reason consistency of performance is the biggest challenge faced by all the categories of active schemes. We know winners keep changing. We all agree to this point. that consistency of performance is the biggest challenge. Now, when we talk about passive, the other aspect of MF, in case of passive, the first thing that comes to our mind when we say passive is what? Nifty 50. Nifty 50, Nifty Next 50, Nifty Mid Cap 150, Nifty 500, all those strategies where index is constructed basis the market cap of the company. Right? So in all those strategies, the biggest advantage that you have is that you are not taking any discretionary call, rather than you are relying on the collective wisdom of the market. Market cap of stocks. See, ultimately the selection is always market cap, then the weights are assigned on the basis of their free float. Right? So the objective is what? To generate returns closer to the market, not to try to outsmart the market. Objective is not to beat the market. Objective is to generate returns closer to the market or in line with the market. That's the biggest advantage. Challenge is what? There is no alpha. And that is why you're not interested in selling that. Now, from an investor perspective, if we understand from an investor perspective, what he wants? Best of both the world. In fact, investors want best of all the world. Right? But let's offer them best of both the world. Active and passive. And that is why a new category has emerged, which is called smart beta investing or factor-based strategies, which actually combine the benefit of both active and passive. Now, how it combines the benefit of both active and passive is that they are also based on certain underlying index, right? Where there is no discretion that fund manager applies. There is simply an index, and as fund manager, we simply replicate that index. So there is no discretion, there is no discretionary risk. However, the index construction is done in a manner that it has a tendency to outperform the market or to generate alpha for you. So basically, it is a bridge between active and passive, and you can call it a hybrid index or something like an index with an alpha generation capacity. Now tell me that between large cap, mid cap and small cap, right? What do you think? What is the most consistent market cap the last 20 years? Mid caps? What is the general belief that we have? Large caps, mid caps, small caps? General belief is small cap. Large cap, mid cap, small cap. In terms of risk also, large cap the least risky, then mid cap, then small cap. But the answer that you have just gave is right. It is not. Mid cap is actually a category which is performing better than large cap, better than small cap. Right? Now, within that, if you actually apply some factor-based strategy. Now, when we say factors is when stocks are selected not on the basis of their market cap, they are selected on the basis of their attribute. Now, that attribute can be, say, price-based attribute. That attribute can be a fundamental attribute. When we say price-based attribute, which means stocks will be selected on the basis of the price behavior, within which the most popular index globally as well as in the Indian markets also at this point of time is momentum. Just now somebody was telling me Bhav Bhagwan, right? In Gujarati they call it Bhav Bhagwan Che. So everything revolves around the price of the stock. Momentum philosophy believes in that only. It picks the stock basis their price momentum on last 6 months and last 12 months adjusted to volatility. When we talk about low volatility, it is a factor that has a tendency to protect the downside. So in a falling market, it falls less. When we talk about quality, it is basically identifying and investing in companies where there is high quality. Now, how you determine quality is basis the current earnings of the company, which is ROE, the strength of the balance sheet of the company, which is debt to equity ratio, and the consistency of generating return, which is earnings growth variability. Similarly, if you see value investing is about identifying and investing in companies which are currently trading below their intrinsic value. So between quality and value, right, what we have seen is that quality is also more from a downside protection. In periods of bearish to flat market, quality has a tendency to outperform, whereas value has a tendency to outperform massively in bull markets, in broad rallies. Right. Now, having said with all these factors, the first question is that do we at all need factors? The answer to that is that if you see the long-term performance, this is the long-term performance for last 20 years, all these factors has outperformed the broad index by 2%, 3%, 4%, some with higher standard deviation, some with lower standard deviation. But all of them have generated alpha over broad market. When we show this slide, right, of 20 years return, investors generally ask that we don't invest for 20 years. Our investment horizon is largely 3-year, 5-year, right? So show us something on a 3-year basis, show us something on a 5-year basis, and talk about what is the consistency with which they are outperforming the broad market, right? So if we actually go and check 3-year daily rolling return of all the factors, you can see momentum is a factor which is outperforming the broad market, say Nifty 500 momentum outperforming the broad market, 84% time with average 9% alpha, and 16% time when it is underperforming, the average underperformance is only -3. So can we say that momentum as a strategy is high on consistency? 84% is a good consistency, right? Very good upside capture ratio, and a very comfortable downside capture ratio. The moment you see this for 5 years, you will be amazed with the number. Momentum as a strategy outperforms the broad market 97% time with close to 7.5% alpha. Right? You can see that 97% time with close to 7.5% alpha. Now, what is your average alpha expectation which you think that makes a story interesting? Let's talk about mid-cap category, because we all believe that mid-cap is a market cap segment which has the highest potential, right? So the universe of mid-cap is mid-cap 150 companies. Now, if we pick a factor-based strategy out of mid-cap 150, and let's talk momentum. So there is an index called Nifty 150 Momentum 50 Index, right? So if there is a factor, there is an index, what do you think? What alpha will make this interesting for you to sell? So let's talk about a 5-year CAGR alpha. What is your expectation? Alpha? 3% more than the index. So 3% more than the index. So 3% alpha is what you are saying. Anybody else have any other expectations? 2-3%, right? So if there is an index called mid-cap momentum index, which on a 5 years basis generates 3 to 5% or 3%, 4% alpha, you think it is an interesting story to sell? Right? Now tell me that for last 20 years, if I go and check every day 5-year return, we all understand rolling returns? So based on 5-year daily rolling return for last 20 years, April 2005 till October 2025, there are close to 3,500 periods of 5-year period. 5-year holding period. So for example, investors starting on 1st of April 2005 completed on 1st of April 2010. Similarly, somebody started on 2nd of April 2005, completed on 2nd of April 2010. Likewise, there are 3,500 observations of 5-year period. What do you think? What is the consistency of mid-cap momentum outperforming mid-cap 150 that you need to sell that story? How many percentage of time ideally mid-cap momentum should outperform mid-cap 150? Tell me an active mid-cap scheme which is outperforming mid-cap 150 100% time in 5-year investment horizon, sir. So let's be reasonable. Let's be reasonable. 80%, right? So anything 80% is a good story. Now let me actually introduce you to this index, which is Nifty Mid-Cap 150 Momentum 50 Index. And we spent 2 minutes in understanding the construction of this index, because that is the base that we have to start with. Now, if we actually see this index, the universe is 150 stocks. Out of 150 stocks, it picks 50 stocks on the basis of their price momentum available in them in last 6 months and last 12 months, adjusted to volatility, right? Now the stocks are assigned momentum score using 50% weight to last 6 months, 50% weight to last 12 months to arrive at momentum score, and the stocks are then being ranked on the basis of their momentum score. And the top 50 stocks with the highest momentum score becomes part of the index. Now once you have selected the stocks, that these stocks will form part of the index, what is the next step? The next step is to assign weight to these stocks. Weight is a function of their momentum score as well as free float market cap, where there is also one condition that none of the stock will have a weight of more than 5%. So you're also getting stock level diversification. And this index, once constructed, is being reviewed and rebalanced semi-annually in the month of June and December. Again, the same exercise will be done. So what we have seen historically is that every time the rebalancing is happening, out of 50, minimum 22 stocks move out and 22 stocks come in. Which means this index has a portfolio turnover ratio of more than 90%. Technically, you are getting a new portfolio every year without any tax implication. Right? Now let's see the return part of this index. So if we actually see the long-term return, last 20 years CAGR return, this index has delivered close to 6% return, 17.6 against 23.4, beating your alpha expectation of 3% handsomely. Now see the risk that it is bringing. The volatility of mid-cap 150 is 20.8. The volatility of mid-cap momentum is 21.1. Very similar standard deviation. Therefore, substantially high risk adjusted return and lesser beta. Now one question I always keep on receiving is that how come it is lesser beta? Because it is a gradual process of picking up winners and removing laggards. Every time when it is rebalanced, it picks the stocks which are higher on momentum and removes the stocks which are less on momentum. And that is why it has a lesser drawdown. It actually has a lesser beta.
Can you show us what is the drawdown during the market?
I will actually show you everything. Right. Now, whenever we are worried about drawdowns, normally we are worried about 1 year return. Right? Because in long run, though, everything gets stabilized, everything gets nullified. What is important is to see the behavior of mid-cap momentum in all those periods where in 1 year it has delivered a negative return. Right? And for that, if we understand the behavior of mid-cap momentum across different market scenarios, I think this is little technical, but let's spend 2 minutes here. The universe of mid-cap momentum is mid-cap 150 companies, right? So if I have to assess mid-cap momentum, I have to keep the base of mid-cap 150. For that, what we have done is, we have computed 1 year daily rolling return of mid-cap momentum for last 20 years. They are close to 4,800 observations, 240 observations per year into 20.
1 year rolling period,
Every day rolling period, last 20 years. Then we bucketed all those returns into different return ranges, which means whenever Nifty mid-cap 150 delivered less than minus 10% return in 1 year, and there are 556 such observations. Right? Which means it is a period of extremely bearish market. Now see the average return of mid-cap 150 during that period. It is minus 28.5. Average return of those 556 observations. And similarly, if you see the average return of mid-cap momentum during the same 556 observation, you can see it is minus 24.3. Which means in an extremely bearish market also, it has a tendency to generate on an average alpha of around 4%. Falling less is alpha, right? Similarly, if you go and check the second one, which is between minus 10 to 0, you can again see that mid-cap momentum has generated close to 5.5% average alpha. Then 0 to 10, 4.8% alpha. Between 10 to 20, 7.4% alpha. 7% alpha and 7.7% alpha. So which means across market return scenarios, it has a tendency to generate alpha. So I think that answers that the drawdowns are also very, very comfortable. Now this is 1 year. Whenever we suggest mid-cap momentum, we always suggest that minimum 3-year investment horizon is required, because sometimes 6 months can be very volatile, 1 year can be volatile, and preferably 5-year. I think that is the right assessment, right? First of all, it is equity. Over equity, it is mid-cap. Over mid-cap, it is momentum. So we have to give some investment horizon for them to kind of generate returns, right? So if we actually go and check 3-year daily rolling return, what you can see is that the average return of mid-cap 150 is 16%, whereas average return of mid-cap momentum is 22.2. 6% kind of alpha. Now see the consistency. 88% time it is outperforming mid-cap 150 in a 3-year time frame, which is above 80%, your expectation. And the average alpha is 7.1, which is better than your average expectation. And see the average downside. In 12% time, when mid-cap momentum is underperforming mid-cap 150, the average underperformance is only closer to -2. So can we say it has a good consistency with a very good upside capture ratio and a very comfortable downside capture ratio? Can we say this? Now the moment you see this in 5-year, because I always prefer 5-year when it comes to mid-cap momentum, you can see mid-cap momentum outperforming mid-cap 150 100% time with close to 6.6% alpha. So actually expectation met reality. Somebody said 100%, right? This is what it is. In a 5-year investment horizon, mid-cap momentum is outperforming mid-cap 150 100% time. Right? Even if we go and check various periods of bull cycles, bear cycles, and periods of consolidation, you can see that in the periods of bear cycle also, mid-caps on an average has outperformed the broad index, which is mid-cap 150. Be it global financial crisis, Eurozone debt crisis, COVID, in the recent fall also, if you see the fall of mid-cap momentum is not massive. Versus in a rising market, the kind of alpha that it is generating is superlative. Right. Now the question is that when I am doing a mid-cap momentum, which means technically I am selecting 50 stocks out of the universe of 150 stocks. So it is as good as active selection, where I am not the selector, a rule is a selector. So I think ideally I should also compare it with all the actively managed mid-cap schemes. Now, one question from all of you is that when the scheme categorization happened? 2018. So if I actually want to do a comparison, I should ideally compare from 2018 onwards, because that will be right assessment. So from 2018 till October 2025, we have a 7.5 year of history. And that is also very recent. It is not like Baba Adam Zamane ka thing. Like last 7 years has been very, very recent one, where we have seen lot of volatility. COVID was there, where lot of mid-caps were sitting in say 20% cash. Then there was Russia, Ukraine. Then there was Israel, Hamas. Then there were recent fall. There were all sort of things that has happened in last 7.5 years, right? Now, whenever we want to assess mid-cap momentum or any mid-cap strategy, we should give 3-year investment horizon. So we should actually assess them on the basis of their 3-year daily rolling returns. So from April 2018 till October 2025, 7.5 years, there are close to 1128 observations of 3-year period. Right? Now tell me, take a wild guess, out of these 1128 observation, what is the percentage of time mid-cap momentum has outperformed the actively managed mid-cap schemes? What is the percentage of time? Out of 1128 observation, what is the percentage of time mid-cap momentum has outperformed the actively managed mid-cap schemes? 80-70%. 87-88%. Then so you should only sell mid-cap momentum. I may be bullish on everything, sir. But you are selling actively managed mid-caps. That too big time. So you are saying 70%? 30%, 60%, 45. Now, if they are beating, say, whatever percentage, what is the average alpha mid-cap momentum is generating over actively managed mid-cap schemes? Alpha. 1 to 2%? Yours, sir? 2 to 3%, 5%? Double digit. Right? Now, let's see it by yourself. This is based on 3-year daily rolling return, April 2018 till October 2025, 1128 observations of 3-year period. Let's go scheme by scheme. HDFC is the largest scheme in the category in mid-cap. Mid-cap momentum is outperforming HDFC 80% time with 7.4% average alpha. Right. But that you were saying basis my confidence, not yours. Right. 20% time when it is underperforming, the average underperformance is only -2. So again, can we say it has better consistency with a good upside, with a very comfortable downside? Second, Kotak, the second largest fund, it has outperformed Kotak Midcap 100% time with 6.7% alpha. Third, Nippon, 91% time with 7.5% alpha. If we go and check the average, it has outperformed 92% time all the actively managed mid-cap schemes with close to 9% alpha. And this is a recent data. This is not something I'm talking about like 20 years back. Despite a recent underperformance in momentum strategy, because in periods of trend reversal, momentum has a tendency to underperform. Now, when we break this entire observation in a block of 2 to 100 now, you see in the first 200, Axis was doing well, then Quant was doing well, then PGM was doing well, recently Motilal is doing well. So winners will keep on changing while this is consistency. So the concluding remarks that we are trying to make is that we are not saying active versus passive. What we are saying is active and passive. Because if you actually introduce within your overall mid-cap category a scheme like this, it will act as a booster, at the same time will bring consistency to the overall portfolio. So investors, if you see investors, what they want is want more consistency. They don't want too much of outperformance. They're more interested in consistency. So if you actually are giving a mid-cap exposure and you are using 1-2 active schemes, also put one scheme like this, like a mid-cap momentum, that will only enhance investors' experience of taking exposure into mid-caps. I think that answers the first question, that alpha is not a problem in passives. I mean, you all have to agree on this, if the numbers are right. Right? So, alpha problem is actually not the case. In fact, it is giving a very tough competition to active schemes also. Secondly, if we talk about the commercial aspect, right? So, I am not doing that because post 2018, none of the mid-cap schemes were actually mid-caps. Right? Now, coming to the second point, in the interest of time, we have very limited time. Active scheme brokerage are a function of AUM. As and when the AUM will keep on increasing, the TRs will have to come down, your brokerages have to come down. Now, what is the brokerage in HDFC? Or for that matter, Kotak, or for that matter, Nippon? Because of their sheer size, I think brokerages must be in the limited range, between 70 to 80 basis point, and that too I'm saying on a very aggressive side. In case of these smart beta strategies, the brokerages are also in the range of 65 to 70 basis points. So it is not commercially inviable for you, and the kind of alpha it is making, the difference will also be taken care by the fund. So it is not commercially inviable for you, it is also commercially viable for you. And the third point with respect to understanding, I think we have made this clear in the last 30 minutes. True? Which means I have actually answered all of the three, observations points that you had with respect to index investing. Is that true? So can I expect that next time when we are having this kind of a conversation, the hands will be at least more? Right? Let's give an active consideration to them. Let's give them an active, space to fight. Secondly, I'll just take 5 more minutes with respect to a very heated discussion these days is about the precious metal, gold and silver. What are your views? You guys are exposing your investors to gold, silver? What is the reason of giving them the exposure of gold and silver? Stability, they are asking.
Ankit, it's come to a stage that we are denying, they are asking.
Now, if you ask me, the role of a precious metal in investors' portfolio is just to do 3 things. Hedge against inflation in long term, hedge against currency depreciation, and to support your portfolio during periods of economic uncertainties. It is actually an insurance of your portfolio. And in that process, if you generate returns, it is all complementary in nature. You have ordered a coffee, cookies came along, you enjoy it and just move. So returns should be considered from that perspective.
But the point here is, we order for a coffee, but cookies keep coming on.
Actually, cookies are not coming, they have become very delicious. Right? Now, what we need to understand is what is the way forward. Right? So, if you see in case of both the precious metal, can we manufacture them? Can we manufacture gold and silver? Never, not in India or not in globe. You cannot manufacture, you can mine it. And there is a limited supply. So, in any precious commodity, supply is limited and therefore the demand drives the price. If the demand is high, price will increase. If the demand is low, price will decrease. Now let's analyze it gold and silver, and I'll just do this in 5 minutes. In case of gold, the determinants of demand are 4 things. Interest rate outlook, investment demand, consumption demand, and demand from central banks. Investment demand in a falling interest rate scenario becomes very, very favorable for gold as demand. Investment demand with the kind of geopolitical uncertainty, tariff war situation, everybody wants to take exposure to gold from an investment perspective to hedge their portfolio. So investment demand is also very strong. Consumption demand is also very strong because people might be buying less gold, but the number of people that are buying gold have increased massively because they want to hedge future. And the 4th is demand from central banks after 2022 has also been very, very strong. So all the factors, if you see from a demand perspective with respect to gold, is very strong. And we are no commodity experts, cannot give you any price target, but if you see the global reports, everybody is suggesting somewhere between $5,200 to $5,500 in gold, which is currently at $4,300, which means a good upside from these levels also. If we talk about silver, silver again the same demand supply dynamics. Now the silver is different from gold. While gold is 90% precious metal and 10% industrial metal, silver is reverse. Silver is 60% industrial metal and 40% precious metal. Now what is happening in case of silver is that silver is a byproduct. Silver gets extracted while extracting zinc, lead, nickel, copper, gold. It is a byproduct. Primary silver mining is only 20%. In case of silver, the supply-demand dynamics is very, very favorable in terms of demand. On an average, the demand is close to 1200 million ounce, whereas the supply is only 100 million ounce, 1000 million ounce, which means there is a structural supply deficit. And the cumulative supply deficit at this point of time is close to 800 million ounce, which is as good as a year's total supply. So there is a structural supply crisis, and there is no immediate relief because the primary silver mining takes 8 to 15 years to start producing silver. Secondly, if you see the industrial usage of silver is only increasing because it is largely used in all the clean energy, green energy initiatives, your EVs, solar panels, solar photovoltaics, AI manufacturing. So this demand will only increase from these levels. And third is that few of the central banks have also started taking exposure of silver as part of diversification, that is putting an additional layer of demand on silver. Having said that, The commodity experts that you are seeing are currently suggesting somewhere between $75 to $90 by 2026 in silver, which means there is a still strong room for silver. So you can take a tactical call between gold and silver. If you cannot, take a 50-50% exposure to gold and silver and consider, we all understand equity very well, right? So consider gold as your large cap, silver as your mid cap, and do a 50-50% allocation to large cap and mid cap with commodities. So, see, what problem is that copper is not allowed. So I cannot explain that in India, regulator doesn't allow copper. I think that's all from my side. More than happy to kind of take questions offline if you have any. So when you take multi-asset allocation fund, multi-asset allocation also take exposure 10 to 15% of their overall portfolio. Now, if you have 100 rupees, you will deploy only 10-20 rupees in multi-asset. That will deploy 10% into gold. So technically, your exposure is only 2%. Huh? Correct. That is why I said that gold and silver is not for generating returns. It is an insurance plan for your portfolio. In that process, return is generated. It is complementary. So expect a 8 to 9% return in your precious commodity exposure only. Now we have got 100% return in last 1 year. That is bonus. But don't expect such kind of returns. Sorry. Sure. Thank you. Thank you, everyone.
Generally, what happens is actually in Hindu mythology, we associate Edelweiss Sani for something that's a bad omen, right? But now Ankit has taught me 7.5 years is not bad omen, it's something that's good for the investors. And most of the time Ankit was doing passive investment, but Magesh is actively promoting his product sitting next to me. So I think half of the job has already been done. He has done only 70% of the job, rest of the 30% we all will do. Thanks Ankit, thanks for that. Thank you. So ladies and gentlemen, next, what happens is when there is always new opportunities. Thank you. Thanks, Ankit.